Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. A merchant cash advance (MCA) has emerged as a popular alternative business financing option for small and medium-sized businesses. It offers a fast and flexible funding solution by providing an upfront cash injection based on your business's future credit and debit card sales. Unlike traditional bank loans, an MCA typically does not require collateral, offers quicker approval, and can accommodate businesses with lower credit scores. Understanding merchant cash advance. In the realm of alternative business finance, a merchant cash advance (MCA) stands out as a popular option for many SMEs in the UK. This financial tool provides your business with an upfront sum of cash, which is then repaid as a percentage of your future card sales. The MCA repayment process isn't tied to fixed payments or terms, and no security is typically required. As a business owner, you might find MCA an attractive option for quick access to capital when traditional loans are not a feasible choice. The approval process for a merchant cash advance is typically swift and is not overly dependent on your credit score, offering a lifeline for businesses in need of quick cash. However, it's essential to be aware that MCAs often come with a higher cost compared to other financing options, and the repayment scheme might not be suitable for every business venture. To determine whether an MCA is the right choice, you should consider your specific financial needs, ability to handle the repayment structure, and other options available. Some companies offer merchant cash advance to SMEs in the UK, with flexible terms and percentage-based repayments. Analyze these options and carefully assess the suitability of an MCA for your business finance needs. At its core, a merchant cash advance offers your business a short-term financing solution by leveraging your future debit and credit card sales. While MCAs may have their advantages, the cost and repayment structure must be thoroughly evaluated to ensure they are a suitable choice for your business's financial health. How merchant cash advance works. A merchant cash advance (MCA) is a financing option that can provide your business with access to quick capital. In an MCA, the lender provides you with an upfront sum of cash in exchange for a percentage of your future card sales, specifically debit and credit card transactions. To better understand how this works, let's break down the key components. Firstly, the advance refers to the sum of money you receive from the lender. This amount is typically based on a portion of your business's monthly card sales, which can range between £10,000 and £300,000. Your card sales play a vital role in determining the size of the cash advance you can obtain. The lender will assess your debit and credit card transaction history to evaluate your eligibility and the potential advance amount. Considering the fluctuations in sales, the repayment process for merchant cash advances aligns with your business's cash flow. Your automatic repayment is typically set as a fixed percentage deduction from your daily or weekly card sales. This means that during slower sales periods, your repayment will be lower, providing flexibility and easing the potential strain on your cash flow. When entering into a merchant cash advance arrangement, it's important to be aware of the percentage of future sales you agree to allocate to the lender. This percentage, known as the holdback rate, can range anywhere between 5% and 30%. It is crucial to ensure you can comfortably manage this rate on top of your regular business expenses. In summary, a merchant cash advance works by providing you with fast access to funding in exchange for a percentage of your future card sales. This form of lending adapts to your business's cash flow, automatically adjusting repayment amounts based on your debit and credit card transactions. Eligibility and application process. When considering a merchant cash advance (MCA), it is essential to understand the eligibility criteria and the application process to make the most suitable decision for your business. The following paragraphs aim to provide a clear and knowledgeable overview of these aspects in a neutral and confident tone. Firstly, to be eligible for an MCA, your business needs to be situated in the UK and should be trading for a minimum of 6 months. Moreover, your monthly debit and/or credit card sales need to be at certain level. Some lenders insist on at least £10,001. Some providers may also require you to have a minimum of £4,000 plus in monthly card revenue, along with minimum 10 or more card transactions per calendar month too. If you're seeking an advance over £75,000, you might be asked to be a property owner too. Applying for an MCA involves a straightforward process. You will typically need to provide your recent bank statements, proof of identity, tenant or mortgage agreement, and your business's trading history 3. During the application process, most providers will assess your business's creditworthiness and financial health. One important aspect to consider when evaluating an MCA is the factor rate, which determines the amount you repay. Factor rates varies, depending on your business's creditworthiness and finances 3. For example, with a 1.5 factor rate, every £1,000 you receive, you'll need to repay £5,003. Another key aspect is the repayment method, which is usually tied to your credit card transactions. The lender collects a fixed percentage payment of the total card transactions processed each month, typically between 10% and 25% for. This continues until the money borrowed is repaid, and each monthly repayment adjusts according to the actual credit card transactions made by your business for. In summary, assessing the eligibility criteria and understanding the application process for a merchant cash advance is crucial for business owners to make well-informed decisions. Ensure that your business meets the requirements and that you're comfortable with the repayment terms before applying. Costs and repayment structure. When considering a merchant cash advance (MCA) for your business, it's essential to understand the costs and repayment structure involved. Since MCAs are not traditional loans, their pricing and terms are different, too. Instead of interest rates, MCAs use what's called a factor rate to determine the cost of the advance. The factor rate is typically a decimal figure, such as 1.2 or 1.3, which represents the total repayment amount as a multiple of the initial advance. For example, if you receive a £10,000 advance and have a factor rate of 1.3, you'll be expected to repay £13,000 in total. The repayment structure of a merchant cash advance is designed to be flexible, adjusting to your business's cash flow. Repayments are usually taken as a percentage of your daily credit card sales, which means your repayments will fluctuate depending on your sales volume. This can be particularly helpful during slow periods, as you'll pay a smaller amount when your sales are lower. It's important to be aware of the fees associated with MCAs. Some providers may charge a setup fee or an administrative fee, so make sure to factor in these additional costs when determining if an MCA is right for your business. In terms of comparison to traditional loans, MCAs often have higher costs. The annual percentage rate, April, can be a useful tool in assessing the true cost of an MCA, as it takes into account both the factor rate and the repayment term. Keep in mind that APRs for MCAs may be significantly higher than for traditional loans, so carefully assess whether the flexibility and quick access to funds are worth the added expense. In summary, merchant cash advances offer a unique and flexible financing solution for businesses with a high volume of credit card sales. Understanding the costs and repayment structure, such as factor rates and fees, is crucial in determining if an MCA is the right fit for your business. Benefits and drawbacks of merchant cash advance. A merchant cash advance (MCA) can provide your business with quick access to funds, which is one of its main benefits. This type of financing is especially suitable for businesses with limited financing options, such as those with a poor credit history. In addition, the application process for an MCA is usually simple and less tedious than applying for a traditional bank loan. Another advantage of an MCA is the flexibility in repayment terms. Instead of a fixed monthly payment, you'll be paying the MCA provider a percentage of your daily credit and debit card sales. This means that during slow months, your payments will be lower, and you won't feel the strain on your cash flow as much as with a fixed loan payment. However, there are also some drawbacks to MCAs. One major downside is the high interest rates that providers charge. In some cases, the annual percentage rate, April, for an MCA can range between 60% and 200%. The high interest rates can significantly increase the overall cost of the financing, making it a less attractive option compared to other types of loans. While an MCA can provide much-needed funds in a short amount of time, the repayment costs can be a burden on your business. Since the MCA provider takes a percentage of your daily sales, it might limit your business's daily cash flow, making it difficult to cover operational expenses. Also, if your sales decline, the repayment period of an MCA can extend significantly, leading to a longer repayment time than initially planned. Lastly, relying on MCAs as a financing option can potentially damage your credit score. Although MCA providers usually don't report to credit bureaus, too many cash advances may create a negative perception of your business's financial health. Potential lenders might be hesitant to approve future loan applications if they see that your business has a history of using MCAs. In summary, while MCAs can offer your business quick access to funds and flexible repayment terms, carefully consider the potential drawbacks such as high interest rates and impact on your daily cash flow. Ultimately, it's essential to evaluate all financing options and choose the one that best suits your business's needs. Merchant cash advance versus traditional bank loans. When you're exploring financing options for your business, you might consider both merchant cash advances, MCAs, and traditional bank loans. Each option has its own set of advantages and drawbacks, which we'll outline in this section. An MCA is a type of financing that offers your business an upfront sum of cash in exchange for a percentage of your future credit card sales. It's a quick and flexible option for businesses that need access to working capital but struggle to qualify for traditional loans. Source. On the other hand, a traditional bank loan is a more conventional form of financing, whereby you borrow a fixed sum of money and repay it over a predetermined period, usually with interest. The approval process for a bank loan might be stricter, requiring a good credit score and extensive documentation. Source. Here are some key differences you should consider. Repayment structure. With an MCA, your repayments are made as a percentage of your daily credit card sales, meaning that repayments fluctuate based on your turnover. In contrast, traditional bank loans require fixed monthly payments, regardless of your sales figures. Application process. Applying for an MCA typically involves a shorter, less complex process, allowing you to access funds more quickly compared to a traditional bank loan. Bank loans often require extensive documentation, collateral, and may take weeks to get approved. Source. Qualification criteria. MCAs are designed for businesses that can't qualify for traditional bank loans due to lower credit scores or limited trading history. In contrast, bank loans generally require a solid credit history and proof of your business's profitability. Cost. MCAs can be more expensive than traditional bank loans, as they charge a factor rate, typically between 1.1 and 1.5, on the borrowed amount. This means you'll pay more in fees than you might with a lower interest business loan. Flexibility. MCAs provide greater flexibility in terms of how you use the funds, as there are often fewer restrictions compared to traditional bank loans. In summary, consider your individual business needs, financial health, and ability to meet various requirements before deciding whether an MCA or a traditional bank loan is the best fit for your business. Merchant cash advance for different industries. As a business owner, you may be considering a merchant cash advance, MCA, to help resolve short-term cash flow difficulties or fund growth opportunities. This financing solution is particularly popular among UK businesses in industries where credit card payments are prevalent. Let's examine how merchant cash advances can benefit various sectors, such as restaurants, hotels, and other UK establishments. In the restaurant industry, cash flow is often volatile due to seasonality or fluctuating customer traffic. A merchant cash advance allows you to access funds based on your business's credit card sales, making it an ideal financing tool for restaurants. The advance can be used for inventory purchases, renovations, or even hiring additional staff during peak times. Since repayments are tied to your credit card sales, you can enjoy the flexibility of repaying more when business is booming and less during quieter periods. Similarly, the hotel industry can greatly benefit from merchant cash advances. Due to seasonal variations, hotel occupancy rates can fluctuate, affecting cash flow. By obtaining an MCA, hotel owners can finance necessary upgrades or cover operational costs during low occupancy periods. Repayments are proportionate to credit card sales, thus ensuring a manageable repayment schedule that adapts to your business's performance. For other UK businesses that operate in the retail or service sectors, a merchant cash advance can offer the working capital needed to seize growth opportunities or mitigate cash flow challenges. MCAs are suitable for businesses that have been trading for at least 6 months and take a minimum of £10,000 per month in debit and/or credit card sales. One of the primary advantages of a merchant cash advance as a form of business funding is its accessibility and speed. Unlike traditional loans, MCA approval is often quicker, with funds becoming available in just a matter of days. The repayment structure also appeals to many business owners, as it offers a flexible alternative to rigid monthly repayments. In conclusion, a merchant cash advance can be a valuable financial tool for various industries, particularly for UK businesses that rely on credit card sales. Whether you own a restaurant, hotel, or another establishment, an MCA can provide the necessary funding to support your business's growth and success. Merchant cash advance for poor credit. Having a poor credit score can make it difficult for you to secure traditional business loans. However, a merchant cash advance (MCA) could be an ideal solution for you, as it is generally more flexible and doesn't rely solely on your credit score. An MCA is a type of unsecured business funding based on your credit card sales. To qualify for an MCA, providers focus on your business's financial performance, specifically, your daily card transactions. As a result, you can obtain quick funding even if your credit score is less than perfect. When you receive an MCA, you agree to repay the advance through a percentage of your future credit and debit card sales. This repayment structure allows for flexibility, as the amount you repay adjusts according to your sales volume. During periods of lower sales, you'll pay back less, while higher sales periods will see you repay more. Obtaining a merchant cash advance with poor credit offers several benefits. Quick application process. With a high approval rate, MCA providers can approve your application in 24 to 72 hours. This is particularly helpful if you need immediate funds to cover expenses or take advantage of an opportunity. Flexible repayments. The repayment structure is designed to work with your business's cash flow, ensuring that you can manage the repayments even during periods of fluctuating sales. No collateral required. Unlike other borrowing options, you don't need to provide any collateral for an MCA, which makes it a suitable option for businesses with limited assets. However, there are a few drawbacks to consider. Higher costs. MCAs can have higher costs compared to traditional loans due to their unsecured nature and the added risk for the provider. Potential for debt cycle. As your repayments depend on your card sales, securing multiple advances may lead to a debt cycle that could hinder your business's financial stability. In short, a merchant cash advance can be an effective funding solution if you have a poor credit score. By understanding the advantages and disadvantages of this financing option, you can make an informed decision about whether it's the right fit for your business. Concluding remarks. In the realm of financing options, a merchant cash advance (MCA) offers a unique and flexible solution for businesses that require a quick infusion of cash. By providing funding based on your future sales, an MCA empowers you to invest in the growth of your business without the constraints of fixed monthly payments. As you consider the viability of an MCA for your business, it's essential to develop a solid business plan that outlines the purpose of the funding, the potential impact on your growth, and how you intend to repay the advance. Factor in details such as the percentage of daily sales allocated towards repayment and any additional costs or fees associated with the MCA. Your plan will help you gain a clear understanding of the benefits and potential drawbacks of this financing option. One of the key advantages of an MCA is its ability to accommodate fluctuations in your sales, as repayments are based on a percentage of your daily earnings. In periods of low sales, your repayments will be reduced, providing some relief during challenging times. Conversely, when your business prospers, the quicker repayment of the advance allows you to move forward with your growth initiatives sooner. In summary, pursuing a merchant cash advance can be an effective strategy for businesses seeking a flexible financing solution that adapts to their sales patterns. By carefully assessing the potential impact on your business and developing a comprehensive plan, you can make a well-informed decision regarding the suitability of an MCA to fund your growth aspirations. What are the common requirements for obtaining a merchant cash advance? To obtain a merchant cash advance, your business typically needs to have been trading for at least 6 months and generate a minimum of £10,000 per month in debit and/or credit card sales. 1. Lenders will assess your business's creditworthiness and ability to repay the loan before providing the funds. How does the repayment process work in merchant cash advances? Repayments are taken automatically from your card sales every business day. 2. With a merchant cash advance, you sell a provider a set percentage of your future card sales, and the repayments adjust according to the volume of your sales. As a result, if your sales are high, you'll repay more quickly, and if sales are low, repayments will be lower. What are the main differences between a merchant cash advance and a traditional business loan? A merchant cash advance is not a traditional loan. Instead, you receive a lump sum payment in exchange for a percentage of your future card sales. These advances are more flexible in terms of repayment, as it adjusts based on your business's sales. Traditional loans, on the other hand, are fixed-term loans with a set repayment schedule. How is the factor rate used in calculating merchant cash advance costs? The factor rate, also referred to as the buy rate, is a decimal number typically ranging from 1.1 to 1.5, which represents the total cost of borrowing. The factor rate is used to calculate the total repayment amount. You multiply the advance sum by the factor rate to determine the total amount you'll have to repay in the long run. What are the advantages of choosing a merchant cash advance over other financing options? A merchant cash advance can be faster and easier to obtain compared to traditional loans, as it requires fewer formalities and has a more straightforward application process. The flexibility in repayment terms, adjusting to your business's sales volume, can be beneficial, especially for businesses with seasonal or fluctuating sales. Are there any specific industries that benefit more from merchant cash advances? Businesses that primarily accept debit and credit card payments, such as retailers, restaurants, and hotels, may find merchant cash advances appealing due to their repayment structure. Industries with unpredictable or highly seasonal sales can also benefit, as repayments align with the business's cash flow, reducing the financial strain during slower periods. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.